This video includes the first 7 sections of Chapter 25. The last section about pricing is in a separate video due to length. So here in Chapter 25, we will look at short-term business decisions. Short-term keys us in that we are at a time frame of 1 year or less. Some in one decision scenario will vary from that. And we're looking at some business decisions. In fact, we will see 6 different types of business decisions, and we will see how the thought process in this chapter will help us out in both those types of business decisions and in many others too. So this is a very useful chapter. You'll employ some of the reasoning in this in your job, and you'll see how we have a good way of analysis in this chapter, shall we say. Because in each of the 6 different decision scenarios we will see at least 2 decision alternatives from which we can choose. We will analyze each of those decision alternatives to determine which one is the best for the company from the standpoint of most increasing net cash inflows. Before I get to the different decision scenarios and see some numbers in there, by the way, those numbers are not difficult. Most people do very well in this chapter. Well, before we do, I have a little introduction with some material that we need as background. So we'll be examining the income effects of alternative management decisions in this chapter. And the basic decision rules to choose the alternative which most increases net cash inflow. And as with most other scenarios in managerial accounting, the cash basis is more important than the accrual basis because managers are concerned with cash inflows and cash outflows. You may remember in the chapter on the statement of cash flows in the first course that in the end, if we totaled up the entire business's life, its net cash inflows would equal its cumulative accrual accounting income. So it's the same except for a timing difference. If we're trying to run a company, we're concerned with paying our bills, so generally we like the cash basis. Then, in the chapter, we will look at relevant costs and relevant revenues. Well, they will differ between the decision alternatives under consideration. Excuse me. We usually evaluate alternatives in terms of future and not past cash inflows and outflows because we can control the future, but we cannot do anything about the past. Relevant costs include outlay costs, which means cash expended directly out of pocket, and possibly opportunity or foregone costs. For example, one decision that we will look at will be whether to insource a component of our product or outsource it. We can have an opportunity or foregone cost or something that we give up there. In the example that we will see, if we insource, we will have to take the production facilities ourselves instead of leasing them out for some additional cash. So that would be an opportunity cost if we insource. I will explain it. Well, sometimes relevant costs and revenues are termed differential costs and revenues. Same thing. Then if a cost is not relevant, it is irrelevant, NC. So irrelevant costs and irrelevant revenues will not differ between the alternatives under consideration. And irrelevant costs may be outlay costs or opportunity costs that we just saw, or sunk costs. So a sunk cost, it results from a past decision. They represent past cash outflows. They are not relevant costs because they will not differ in the future between the alternatives. Well, some costs include historical costs of assets. In fact, in the first decision we will see, we will look at the past or historical cost of an old machine and decide whether to replace it. Well, hint, hint, that past or historical cost is a sunk cost. We should not consider it because that money is already gone. But psychological research shows that people try anyway, so we won't fall for that. Then, also depreciation is always irrelevant, partially because it's based on the sunk cost of the asset. The second reason is because under accrual accounting, depreciation is an expense. It is not under the cash basis. It's not an expense under the cash basis. So depreciation does not involve a cash outflow. That is why. And also, gain or loss on disposal of old assets is not relevant. It's not a direct cash flow. However, salvage or residual value will be relevant. So if someone gave us a little bit of salvage or residual value for the old machine, if we're replacing it, that will be relevant because it has a future cash inflow. Then D, we'll see that fixed costs may be relevant, especially if we were considering long-run situations. Well, in the next chapter, we will see the long run. So fixed costs will come up much more there than the short run is in this chapter. Well, fixed costs, which will not change between the alternatives, are always irrelevant. They will not make a difference to the decision. Again, I will show you in some numbers in just a bit. And they're often termed unavoidable fixed costs. Well, conversely, all variable costs may not be relevant. So we'll have a special analysis. And we must always consider the total effect of the situation on the company over the relevant time frame for the decision. Unit costs can often mislead if fixed costs are irrelevant, although unit costs can be used in some situations. And one limitation of this chapter is that the time value of money and income taxes are not considered in order to more clearly present the concepts. These topics are covered in the next chapter, which is about long-run decisions for capital budgeting, how we budget spending capital or money, and we'll see some different types of decisions there. Well, keep in mind that dollar figures are not the only input to a decision. Qualitative factors may be relevant too, and we'll consider some possible qualitative factors at certain points in the chapter. One thing will be quality, so it's non-numerical largely, but just something for us to consider. It's subjective. Well, first decision scenario is considering whether to keep or replace an old machine. This one will go a bit out of the 1 year time frame, but that's okay. So this is an excellent example of the irrelevance of fixed costs. And possible relevant factors include sales revenue, variable costs, and fixed costs. So here's an example. Let's consider the Bronson Box Company, and they produce cardboard boxes for sale. It has only one machine on its assembly line that does everything, and the company is considering whether to keep or replace this machine. The old machine has an original cost of $7,000 and is being depreciated at a rate of $1,200 per year. By the way, those are totally irrelevant because they relate to sunk costs. The time frame for this decision is 3 years. We will deal with it. Sales and production volumes are expected to be 20,000 boxes per year. The same for both the old machine and the new machine. So since they're the same, we're looking at something which is irrelevant to the decision. Now, the following boxes or following items will be the same for both machines. The price per box of $7, direct labor, 50 cents per box, and selling and administrative expenses, $3,000 per year, all fixed. So all of those are irrelevant since they do not change between keep the old machine or replace with a new one. So we can actually ignore those as we analyze this. Again, I will show you. The following items though will differ. Direct materials per unit, which is $230 with the old machine, $210 with the new one. So the new machine is a little bit more efficient with respect to the usage of direct materials. Variable overhead per unit, $1 with the old machine, only 80 cents with the new one. Again, variable overhead, the new machine is more efficient. And fixed overhead per year except depreciation. So other types of fixed overhead, $14,000 with the old machine, $11,000 with the new machine. So we could say there that if we replace, we have a relevant cost pertaining to fixed costs of $3,000. The difference between the two, again, I will show you. But we could also say that that $11,000 is an unavoidable fixed cost. Now, the original cost of the new machine is $9,000, and it has an estimated salvage value of 0 at the end of its useful life of 3 years. The old machine could be sold for $1,000 today, net of removal costs, would have no salvage value 3 years from now. So should the company keep or replace the old machine? So in order to do this, I've uploaded a PDF under Files on Canvas for you, and it looks like this of Chapter 25 class examples. So with this machine replacement, I show you two ways. The first way is the long way. It shows you all the factors I just talked about. I don't think you'll even need to do it, but I just wanted it there in case you wanted to see the whole shebang at work. The only number I'm only going to care about is this very bottom line number of 25,000. So here's an alternative way to get to that 25,000. The shortcut method. So this is going to only include the relevant items. And we're going to compute the net advantage of replacement. So how much would replacing the old machine benefit the company? Let's look at, again, only those things which changed. Direct materials is one, because with the new machine, we have a 20-cent savings per box, $2.30 minus $2.10. We multiply that 20-cent savings by 20,000 boxes per year and by 3 years. So that means that at the end of the next 3 years, we will have a net savings of cash if we replace of $12,000. That's a good thing. It's positive in terms of cash inflow, and I do not put parentheses around it as a result. Variable overhead, same computation, the same 20-cent savings per box. That was $1 with the old machine minus only 80 cents with the new machine. So the computation is the same, giving us $12,000. Then fixed overhead. Again, the relevant part is 3,000. The irrelevant or unavoidable part is 11,000. So 14,000 minus 11,000 is $3,000 times 3 years, giving us $9,000 in savings if we replace. So it's a good thing I don't have parentheses around it as a result. Then the cost of the new machine is a cash outflow, $9,000 if we replace. The salvage or residual value of the old machine is $1,000 if we do replace. So if I net this out, I get a net advantage of replacement of $25,000. That says to replace. That's our decision. And again, this $25,000 figure is the only one that I would ever test you on. So the short way will be sufficient. If you want to look the long way, that's fine. Or if you understand things now, I don't think you even need to look back at the long way. All right. Let's come back here to the handout and look at the next decision scenario that we have. So we have here product mix decisions resulting from limited resources. So what type of mix of products could we sell? Let's see. Well, first of all, a company's production may be constrained by a limited resource, such as machine hours, direct labor hours, or raw material supply. So that constraining factor is something that we're going to have to subordinate everything else to, and I will show you how. But this is going to relate to the theory of constraints. Theory of constraints says we must max out in terms of profitability on that limited resource, because that limited resource controls just how many units we can produce on our assembly line. We cannot produce any more than the limited resource. So I will show you now in terms of a limited amount of raw material, which is plastic. So looking here at B, well, our decision rule is to maximize contribution margin per unit as a constraining factor. This is equivalent to maximizing total contribution margin and earnings if fixed costs are the same under each alternative, which they always will be for us. So we can look at contribution margin and it'll be easy for us. So here's an example. If we went to North Florida and went to the little town Mikesville, the Mikesville Microphone Company has only 2,000 pounds of plastic available per year. So there's our constraining factor. It can produce two types of microphones, a clip-on style requiring 8 ounces of plastic, so half a pound, and a tabletop model requiring 1 pound of plastic. The The clip-on style has a contribution margin of $7 per unit, and the tabletop style has a contribution margin of $12 per unit. Which type should the company produce if it can produce only one style at a time and assume it can sell all of its production? Well, first of all, if we had no constraints placed upon us in terms of raw material supply, we would say, let's go for the tabletop style. If we can produce all that we sell, we get $12 per unit. However, the limited supply of plastic is going to change everything. So let me show you that here in the solution on the PDF file, the handwritten file. So first of all, I look at the units per pound of plastic that we can produce. Clip-on style, well, it takes half a pound of plastic. If I divide that into 1 pound, I get that we can produce 2 units of the clip-on style per pound of plastic. Tabletop style, well, it takes the whole pound of plastic. So only 1 unit of the tabletop per pound of plastic. Now let's look at contribution margin per pound of plastic. Well, the clip-on style, we get 2 of those units per pound of plastic. Each one has a contribution margin of $7 per unit. Gives us $14 of contribution margin per pound of plastic. Tabletop style, well, only 1 of those per pound of plastic, and each tabletop style has a contribution margin of $12 per pound. So per pound of plastic, we can only get $12 contribution margin per tabletop model. So we're going to pick the clip-on style. Let's prove that. So the possible production volumes, clip-on style, 2,000 pounds of plastic, and we get 2 units per pound. That's 4,000 units in total. Tabletop style, again, we have 2,000 pounds of plastic, but we can only get 1 of these per pound, 1 unit per pound. Gives us 2,000 units. So here's the possible total contribution margin. Clip-on style, 4,000 units of it, times $7 a piece, which is going to give us 28,000. Tabletop, 2,000 of these times $12 per unit. That's going to give us only 24,000. So obviously we want the higher total contribution margin. Again, as we know, total fixed costs would be the same with clip-on production or the tabletop production. So if they're the same, this change in total contribution margin would be the same difference in operating income. So that's why contribution margin is just fine to look at. Now, let me come back to the handout and look at our next decision scenario. And it's whether to insource or outsource. So if we insource, that means we make a product or a component of the product. If we outsource, we let an outside supplier make it for us and we buy it from them. A very good example is with Publix. So with Publix name brands in the store, Publix does produce some of those, like milk and other dairy products, and produces its own orange juice, its own bottled water. And all those are produced at the West Lakeland plant, by the way. And then others, it will outsource or buy from someone else. And a good example of that would be Publix brand carbonated soft drinks. They buy them from Refresco, who has a plant over on Bartow Highway. Refresco is a Dutch company, and they bought the old Juice Bowl plant. I don't know if anyone remembers that, but they bought that. Juice Bowl used to make a variety of products which contain citrus juice to use up the citrus juice produced around here. So Publix outsources its production of carbonated beverages to Refresco. And depends on what part of the country you're from, if you call those carbonated beverages soda, or if you call them pop like I do. Since I'm from near Chicago, well, I say pop. Well, as we look here, we're going to, again, decide whether we're going to produce a product or service in-house, if we're going to insource it, or buy it from an outside supplier, which is to outsource it. And the decision rule, again, is going to be to choose the alternative which contributes the most to earnings. And that, in this case, is going to translate to having the lowest cost. So let me show you two examples. One is with no opportunity costs. One is with opportunity costs. So the first one would be, if there are no opportunity costs, only the incremental outlay cost from producing the product will be relevant. We'll note that fixed costs may be relevant if we're dealing with a long-run decision, although we won't be here in this class, so we won't have to worry about that. The maximum price the company would be willing to pay the outside supplier would be the relevant outlay cost. Again, I will show you. So here's an example of we went to the small city of Palatka up in North Florida and go to the Palatka Pizza Parlor. They currently buy pizza sauce from an outside supplier at a cost of $12 per gallon. The company is considering making the sauce, so considering insourcing it, whereas they are currently outsourcing it. This will require hiring one additional employee at a fixed cost of $10,000 per year. So in this case, we will have a fixed cost increment or relevant cost. And again, you would be told if you did. Otherwise, assume there is none. So I'll show you how to deal with this when I get to the solution in a moment. Other costs per gallon for producing sauce are as follows. Other labor, which is variable of $2 per gallon. Direct materials, $8 per gallon. And variable overhead, 50 cents per gallon. The company uses 5,000 gallons of the sauce per year. No other increase in fixed costs will result. The facilities used to make the sauce will be idle if the sauce is outsourced. So the facilities, kitchen facilities, if you will, that we're currently taking up to make the sauce, well, if we no longer occupy them by making the sauce because we've outsourced, well, those facilities are just going to sit there. We cannot get any extra revenue for them by letting someone else use it. Well, should the company buy the sauce or outsource it? What is the maximum price per gallon it should pay an outside supplier? I will analyze this for you on both a total dollar basis, total annual basis, and on a per unit basis. So for this, let me come back to the PDF. And I've got right here the solution. So I'm going to look at some totals and in parentheses some per unit amounts. I will have a column for insource or make and a column for outsource or buy. First of all, the outside purchase cost. 5,000 gallons, and we pay this outside supplier $12 per gallon. That is a total of 60,000 per year, or $12 per gallon. And then the cost to make. First of all, I had to squeeze in the first one because I almost forgot about it. It's the extra employee, which is fixed, 10,000 per year. If we divide that by 5,000 gallons, that is $2 per unit. Then direct materials. Well, direct materials, we have 5,000 gallons at $8 per unit for things like tomatoes. Multiply the two, and what we will have then, as far as cost to insource, will be $40,000 regarding direct materials. Again, that is going to be $8 per unit. Then variable overhead, 5,000 gallons of the sauce times 50 cents per gallon. So 5,000 times 50 cents is $2,500, or again, 50 cents per gallon. Now let's total these up. The total relevant cost to insource will be $62.5, or $12.50 per gallon. Total cost to outsource will be $60,000, or $12 per gallon. The decision is to outsource or buy because we save money. By the way, the maximum we would pay this outside supplier would be $12.50 per gallon. So the cost to make or insource. If an outside supplier charges anything else, well, that's good for us because we definitely save some money there. Now let's consider an opportunity cost here in C. Opportunity costs will be relevant, however, if the facilities released due to outsourcing will not be idle. So these kitchen facilities that we no longer need to use because we're outsourcing, we can lease these to someone else for some revenue. So the maximum price the company would be willing to pay the outside supplier would be the relevant outlay cost plus the opportunity cost of insourcing. Here's an example. Let's assume that the Placa Pizza Parlor's release facilities can be leased for a net cash inflow of $25,000 per year, so somebody else can use them then. Should the company outsource the sauce? Well, as the maximum price, it should pay an outside supplier. So if I come back to the PDF for this, I'll analyze this for you, and all these analyses are easy. So the costs from above, those don't change. Here's what we will add: an opportunity cost, lost lease revenue. If we insource, we give up or forego $25,000. So that's an opportunity cost of insourcing. If I divide that by 5,000 gallons per year, that's $5 per gallon. So now the total relevant cost to insource will be $87.5 or $17.50 per gallon. To outsource, still $12. So obviously, our decision is to outsource. Well, the maximum we would pay an outside supplier in this case would be $17.50, because if we spend anything less, I should say, with an outside supplier, we've saved ourselves some money, and that's a good thing. Now, back here on the outline itself, I've got just under here in D, to note the relevant costs may also include any carrying costs of inventory, because we have to, we have to store it, so there are costs attached to that, and any imputed costs, such as investment income foregone because money is tied up in inventory. Inventory does take up money. We might be able to use it elsewhere. We won't consider those costs further, though, in this course. Something else we could consider here is quality. It's a qualitative factor. It may be the customers perceive that our own homemade sauce that we insource has higher quality than the outside supplier gives in the outsourced sauce. So that could be another consideration here. That's just not one that is very easily boiled down to numbers. Now, another decision scenario that we have here is whether to keep a customer. Customer profitability. Well, some customers just aren't worth it. A good example is banking. So in banking, if you're a low balance customer, you get charged for everything. The bank said that you're not profitable. In fact, you're incurring a net loss for us. So we're going to turn you into something more profitable by nickel and diming you for everything. Whereas if you're a high balance customer, you're quite profitable to the bank. So then they roll out the red carpet: free checks, free ATMs, free safety deposit box, etc. So as we get into this, we need to think of which costs may be relevant. And the following cost hierarchy helps. Well, at a very basic level, we have output unit level costs. They vary with the number of units produced because they relate to the expenses or resources rather expended on individual units. Examples include variable manufacturing costs like direct materials, many materials handling costs too, as we transport material around the factory, such as with forklifts. So output unit level costs relate to the number of units that we make. Then number two, batch level costs, if we bump up a notch. They vary with the number of batches or groups of the product produced. Examples include setup costs and delivery costs. For example, Refresco, if they were to produce soft drinks for another store, they would have to retool their assembly line as they switch from Publix brand to the other brand. And they don't do that over on Bartow Highway. They are exclusive to Publix. Also delivery costs, because we deliver a batch of the product. Batch level costs, which are traceable to a specific customer, are often called customer sustaining costs, which they are for Publix. Then product sustaining costs, if we bump up another notch. Well, they're related to resources expended to support an individual product, and they are not traceable to the individual units or customers, unless a particular product is produced only for one customer. Well, many research and product design costs are included here. And then facility sustaining costs. Well, they're related to resources to sustain the overall organization. They're not related to specific products or customers. Examples include general and administrative costs. We'd have to close down to get rid of facility sustaining costs. Well, here in B, usually only variable output unit level costs and batch level costs will be relevant in deciding whether to keep a customer. Again, only cash flows are usually relevant. So let me show you an example here. Actually, I have two of them, one without opportunity costs and the second with opportunity costs. So let's go to Sarasota. The Sarasota Sailboat Company is deciding whether to keep an existing customer. These must be toy sailboats given the numbers here, but I try to keep numbers low for you because they're less confusing and they illustrate the point just fine. If we get into too many digits, well, often we can get bogged down to numbers. So sales to this customer are $20,000 per year. Variable manufacturing costs, could also call that variable cost of goods sold, and also variable materials handling costs are $12,000 and $2,000 per year respectively for this customer. The Sarasota Sailboat's other costs, including product sustaining and facility sustaining costs, will not be affected by the decision, should the customer be retained. So let's see if we need to keep this customer or politely tell them no. Let me come to the next page here on my PDF. So the net advantage of retaining this customer. Relevant revenue is $20,000 for this customer. The relevant costs, we only have outlay, we have variable manufacturing of 12, variable materials handling of 2. So the net advantage of keeping the customer, it's an advantage because it's positive. We get a bottom line of $6,000 for this customer. So that's a little customer profitability analysis. Then let's consider opportunity costs. Let me come back here to this handout. So in our second decision scenario, opportunity costs will be relevant. So let's assume that the facilities released from dropping this customer can be used to insource the sailboat part. This part is currently outsourced. This would result in a net savings of $10,000 per year. Should the customer be retained based on this new information? Okay, again, coming back to my PDF solution. Well, first of all the same things from above, this net advantage that we saw of $6,000. However, things have changed now. We have an opportunity cost because we keep this customer. We must give up this $10,000 of savings. That's a negative situation. So I have it in parentheses and as a negative number. So the net advantage of this customer, we have a net disadvantage of keeping the customer, $4,000. So if we keep this customer, we would lose $4,000 of profit. We don't want to do that. The decision is to drop the customer. We're coming back to the outline. Just under that, we can apply the same reasoning here in E. To dropping a product or a department or a territory, it'd be exactly the same. Now, another decision scenario that we have is a one-time only special order. Let's see what that is. This type of short-term pricing decision is discussed later in the chapter. And the scenario is a customer wants to buy our product, usually in large quantity, at a price which is lower than that offered to the general public. So they tell us we're going by a large quantity, but here's what you have to give up. You have to give us a cheaper price. Special order is a good way to fill up excess plant capacity. So again, I will show you with no opportunity costs and then with opportunity costs. So in the short run, a special order will normally change only total variable costs, not total fixed costs, not variable cost per unit. And our decision rule is to accept the special order if its contribution margin is greater than 0. So it turns a positive profit for us. And this means we will accept the special order if the special order price is greater than incremental costs plus opportunity costs. So as an example, let's go up fairly close to Gainesville to the little town of Archer. And up there, the Archer Aero Company is currently producing and selling 8,000 euros per year and has a plant capacity of 10,000 euros per year. The price is $5 each. That's the regular price to regular customers. And a customer proposed special order for 1,000 euros, so a large quantity, at a special price, $2.50 each. That's the special order price. Assume that both the regular and special order arrows will incur variable manufacturing of $2 each and variable selling and administrative costs of 25 cents each. No other upstream or downstream costs will change as a result of the special order. Well, fixed manufacturing is $5,000 per year. Fixed selling and administrative costs are $1,000 per year. Those will not change no matter if we accept the special order or not. So should the company, therefore they will be irrelevant, by the way, because fixed costs are irrelevant. So should the company accept the special order? Well, as a minimum, special order prices should accept. And we will note that per unit cost of misleading this decision of fixed costs were factored in. Fixed costs are irrelevant because they will not change if the special order is accepted.